Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the crude oil, heating oil, and RBOB markets for Wednesday, June 6th. But before getting into the energy complex, we'd like to start off with an update on the S&P market, given the extent to which it's leading a number of the other commodity sectors and certainly the energy complex. In yesterday's technical webcast in the S&Ps, we discussed last Wednesday's 1305 first wave low as the short-term risk parameter we believe this market needed to recover above to confirm a bullish divergence in at least short-term momentum. By virtue of the extent and impulsiveness of overnight's gains above the 1281 high from Monday, we believe this market has proven enough strength to break at least the latest portion of the broader downtrend from that 1334 high from late May, exposing at least an interim correction and quite possibly one that's got some significant legs above it. And as a direct result of overnight's gains, we believe the market has defined the 1267 low from yesterday as the latest corrective low and tightest risk parameter this market is now required to recover above to mitigate any kind of correction or reversal higher, confirm this recovery attempt as a three-wave and thus corrective sequence, and resurrect the broader slide dating back to late March. While this market remains above at least 1267, and for shorter-term traders with tighter risk profiles, we advise a neutral to cautiously bullish policy, approaching dips as interim corrective structures and short-term buying opportunities ahead of a correction or reversal higher that we think will span at least a few days and quite possibly a couple of weeks. Given the prospect, looking here at a daily log scale active continuation chart, the prospect that the 1262 low from Monday completed a five-wave Elliott wave sequence dating from that March 27th high at 1420. Now on this larger degree scale, you can see the developing potential for a bullish divergence in momentum, but that divergence will only be realized to the point of bullish action upon proof of the latest next larger degree corrective high of 1334 from May 29th. So from a longer term perspective, a bearish policy remains advised, but traders, longer term players are advised to pair that bearish policy to a more conservative level given the confirmation of at least intermediate term strength overnight. Again, with strength above 1334 required to negate a broader or defer a broader bearish count sufficient to warrant moving to a neutral sideline position in order to circumvent the heights unknown of a larger degree correction to the March-June decline. Now moving to the energy complex and starting off with the July crude oil contract, you can see the influence the stock recovery is having on crude oil prices, and by virtue of overnight's strength above yesterday's 84.92 high, the market has confirmed at least the short to intermediate term trend is up. And has defined the 83.31 low from yesterday as the latest corrective low and tightest risk parameter this market's now required to fail below to render this recovery attempt a three-wave and thus corrective sequence consistent with the broader bearish trend. You can see also an area of former resistance, new support in the 84.90 area that would be expected to hold if this market's embarking on a steeper correction higher that we believe it is on at least a short to intermediate term basis. This said, shorter term traders with tighter risk profiles are advised to move to a neutral to cautiously constructive or cautiously bullish stance with protective sell stops just below 83.31. From a long-term perspective, however, looking at a daily log scale chart, you can see the magnitude of the May collapse that really we believe is only the third wave of an eventual five-wave sequence down, suggesting that this recovery attempt is just a fourth wave correction that could be relatively substantial ahead of a resumption of this broader down channel. Moving to the weekly log scale perspective, you can see the market's return to the lower quarter of the past year's range, where we will anticipate a slowdown in the rate of descent and a larger degree base and reversal process. But again, given the third wave aspects of the May collapse and the proof of just short-term strength thus far, traders still are advised to approach this recovery attempt as just the fourth wave slowdown corrective process with an eventual five-wave sequence down. And we saw that type of price action back in August through October of last year. We can see a relatively sharp correction that was just part of the slowdown process before the ultimate low in October of last year at 74.95 that created the bullish divergence condition in longer-term momentum consistent with a broader base and reversal threat. These issues considered, longer-term traders remain advised to approach this recovery attempt as just another bear market correction, with strength above the 92.21 high from May 29th required to negate that view or threaten that view sufficiently to warrant moving to a neutral sideline position. However, given the prospect of at least short to intermediate term gains in the days and perhaps weeks ahead, longer-term traders may want to pair bearish exposure to a more conservative rate. And again, shorter-term traders with tighter risk profiles are safe to play this market from the cautious bullish side with protective sell stops at 83.31. Similarly, looking at an intraday 4-hourly chart of the July heating oil contract, you can see overnight's break above recent 264.43 area resistance. That's now considered new near-term support. And as a direct result of this minor degree showing of strength, the market has defined yesterday's 260.56 low as the latest corrective low and new tightest risk parameter. This market's now required to fail below to break this developing recovery, render it a three-wave and thus corrective sequence consistent with the longer-term bear trend, and to reaffirm or reinstate that longer-term slide to eventual new lows below 256.41. While the market remains above at least 264.40 and preferably 260.56, we anticipate a short to intermediate term corrective recovery that, given the magnitude of the May collapse, as in crude oil, could be relatively steep. But here again, on a longer term perspective, and given the extent of that May collapse that has third wave written all over it, we fully expect this recovery attempt to just be the fourth wave slowdown process within an eventual 5-wave sequence down to another round of new lows below 256.41. And in this larger degree regard, longer term traders are advised to still use the 285.79 high from May 29th as a long term risk parameter. This market needs to recover above to neutralize all bearish exposure. This said, given the short to intermediate term proof of strength, longer term traders may want to pair bearish exposure to a more conservative degree to circumvent the heights of unknown of this interim correction higher. It's interesting to point out on a daily close only basis, on a linear scale, the recent low daily close at 262.69 was just a few pips away from the 262.95 2.618 progression relationship that makes this suspected third wave down from the 319.84 high from April 26th. Exactly 2.618 times the length of the initial first wave decline from 331.30 to 309.57. On a weekly log scale basis, it's also interesting to point out the extent to which bullish sentiment according to this market has collapsed, understandably, with a 32% reading in the bullish consensus this week being the lowest since August of 2010. But that said, the market has broken below last October's key low to expose the very long-term trend is down. And you can see this area of former support from the 270 to 275 area now is considered key long-term resistance. We expect it to contain this recovery attempt ahead of at least a final fifth wave down within that broader 5-wave sequence down from the late February high. In sum, a neutral to cautiously bullish policy is okay for shorter-term traders with tighter risk profiles, using 260.56 as your risk parameter below which any long exposure should be protected or hedged. And longer-term traders are advised to maintain a bearish policy, albeit at a paired, more conservative rate, with strength above 285.79 still required to negate that call sufficiently to warrant moving to a neutral sideline position. And finally, looking at the July RBOB contract on an intraday 4-hourly chart, we see the same thing. The market has broken above recent short-term resistance in the 269.11 area that now is considered new near-term support. And as a direct result of overnight's gains, the market has defined yesterday's 264.41 low as the latest corrective low and tightest risk parameter that shorter-term traders are advised to use as the risk parameter to protect a cautious bullish exposure in order to participate in at least an interim corrective recovery. From a long-term perspective, however, you can see the magnitude of the collapse from the early April high way up at 342.78, and clearly the confirmed bullish divergence in short-term momentum is of a scale grossly insufficient to suggest anything other than an interim corrective pop within this longer-term slide to eventual new lows below 259.71. And on this longer-term scale, longer-term traders are advised to still use the 287.25 level as the level above which this market is considered confirming a bullish divergence in momentum of a scale sufficient to break this longer-term downtrend and warrant moving to a neutral sideline position. It's also interesting to point out that with respect to an ongoing broader bearish count, while the bullish consensus measure of sentiment according to this market has dropped to a 49% reading, that's the lowest since September of 2010. The MRT Bullish Sentiment Index of the hot managed money positions reportable to the CFTC remains stubbornly high at a 93% reading, reflecting 74,000 long positions to just 5,000 shorts. We believe that leaves the market still vulnerable to further capitulative type selling, and we think it reinforces our still longer term bearish count that any kind of short to intermediate term recovery here is merely bear market corrective ahead of an assault on the key 244 handle lows from late last year. These issues considered, shorter-term traders with tighter risk profiles are advised to maintain a neutral to cautiously bullish policy with protective sell stops just below 264.41. Longer-term traders may want to pair bearish exposure as a result of this confirmation of at least short to intermediate term strength, but from a longer-term perspective, strength above 287.25 remains required to break the longer-term bearish count and expose a larger degree correction or reversal higher. And until or unless such strength above 287.25 is shown, we anticipate this recovery to be a longer-term bear market correction ahead of a resumption of the broader slide from the April high to produce new lows and potentially significant lows below that 259.71 low from early June. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.